Hello, and welcome to today's webinar. My name is John Patterson. I am the dedicated farm agent with Stanberry Insurance for their agribusiness division. And today we're going to be talking about a crop insurance coverage that can be used as a cost mitigation tool primarily for cattle producers, but for those that are raising livestock. So let's get into it. So the purpose of today's program is to discuss crop insurance as a tool to limit exposure. Now, as you can see, that spells out cattle, but I want to focus on that because I don't want anybody who listens to this or who's on with us today to mistake the intention and to believe that this is just some sort of additional product to be sold. The tool that we're going to be talking about today is part of the federally regulated program through the USDA and the risk management agency branch that oversees that program, and it is intended to be a tool to help farmers do what they do and to do it better. So that's the purpose of what we're talking about today. The coverage we're going to be talking about is known as PRF. PRF stands for Pasture, Range, and Forage. So this is obviously where we talk about being for those who are raising livestock, being a good coverage tool for them. So PRF is what it's typically referred to, and that's probably how I'll refer to it through the rest of the presentation. So Pasture, Range, and Forage, or PRF coverage, is designed to help farmers or help cattle producers, those who depend on the hay that they grow or the pasture land that they have to feed and raise their livestock. So this coverage is a rain index coverage, is how it's referred to. So obviously if you get enough land, or if you get enough rain, your land is positively affected by that. If you don't, then the vegetation is affected by that as well. So if you get enough rain, then you usually are going to grow enough hay and you're going to have enough forage on your pasture land to take care of your livestock. On the other hand, if we do not get enough rain, then that lack of rain can mean less hay, it can mean less forage, and as a result, it can mean increased costs for purchasing hay or purchasing feed and having to take care of your livestock where there's additional days throughout the year where you're not able to grass feed or to graze them on pasture because of that lack of rain. So this is what PRF was designed for. This is what this particular coverage is intended to help with. So this is where this can be a really great tool. So let's talk about how it works. The USDA has rain index data on file going back to the 40s. So PRF uses rain index data to determine when you're likely to get rainfall, when you're not likely to get rainfall, and then allows you to select coverage protection for those times where you don't think you're going to get enough rain, but you need it. Those times where, because of not having enough rain, you might sustain additional costs. So the first thing that we do is determine where you're located. So they have grids that are marked out by 17 miles by 17 miles square, and we determine your address for where your farm is or the road where your farm is located on, and we try to get your grid ID number that we can use to find the historical rainfall data for that area. Once we've determined which grid you're in, then we take a look at the rainfall indexes. You can go back, look at last year, you can look back 5 years, you can look back 10, 20, really, like I said, all the way back to into the 40s. Typically I look at a 10-year span of time. That gives us a nice snapshot to look at, and we go from there in terms of determining coverage selections. So third is the coverage selection part. You want to choose intervals. So the way that the system is built, they allow you to look at 2-month intervals throughout the course of the year. So January and February, or February and March, or March and April. And then you look at the intervals and look at the rainfall that takes place within those intervals, and you determine which 2-month interval am I not going to get a lot of rain, because that's the one that you want to try to purchase some coverage protection on. So that's where you go from there. So you determine your intervals, and you have some options on how many intervals you can select and how you can split up your coverage between those intervals so that you can maximize your coverage and your protection within the policy. Once you've done that and it's in place, if the rainfall during the 2-month interval that you've selected is below your coverage level and you don't get enough rain, that is automatically tracked via satellite. We know how much rain you got within your grid, and the policy automatically kicks in and pays you out an indemnity payment. So the word indemnity is to put back the way that it was. It's to indemnify you. So if you don't have enough rain right now, you look at that as just a cost of doing business. But that cost is additional hay, additional feed, additional expenses to your operation. This policy is intended to indemnify you, meaning that it would pay you back or to help to try to reimburse you for some of those additional costs that you would sustain during time periods where you didn't have enough rain. That extra money can make a big difference in an operation. That extra money can be very beneficial to cattle producers who have this coverage and are able to reimburse some of the money that they're paying out of their own pocket into their operations for these extra costs. As a result, PRF could be a very effective tool in the overall management of your operation. There are a lot of tools in your tool belt. If you are a cattle operator, you are probably somebody who is aware of all these different things, sessions on how to better manage your land, make sure you're getting soil samples, make sure your soil is healthy, growing some cover crop, what is your stocking rate on your land, how often are you rotating your herd, all these different things that you take into consideration to try to help you best manage your operation. This is another tool that you can add to your tool belt to help you manage your operation better and to help mitigate your costs throughout the calendar year. So now that we've talked a little bit about how it works, let's look at an actual example. Recently, we had an amazing grazing session in Haywood County, North Carolina, and it's the actual land that we were on for that session that I want to use for this particular example. So as I walk through that, just keep that in mind. This is a specific land for a specific farm where an actual person is raising livestock. So during the session and the conversation, I believe it was mentioned that there's roughly 60 acres of active grazing land on this farm. This producer has cattle, they have some ewes, they have a few horses, I think 3 horses, but primarily it's used for cattle, and I believe that the number was 60 acres, so that's what we're taking into consideration for this quote. So first thing we do is we put in the address. So in this case, we put in the 389 Chestnut Drive in Clyde, North Carolina, which is in Haywood County. It comes up on the map of where the farm is located, and it tells us what the grid ID number for that farm is. So that's the grid ID number for the 17 mile by 17 mile plot of land that farm is located within. From there, we start to look at the historical indexes. So for the purposes of this quote, I did a 10-year snapshot. So I started at 2006 and I ended at 2016. So these are full crop years that have already passed by. We have all the data in place for them. There's nothing outstanding, so it's a good snapshot to look at. So then we look at the intervals, as you can see, January, February, February, March, March, April, as I mentioned. Within those intervals, it shows for the calendar year what, so for like 2016, for example, during the March and April interval, you got a below average rainfall for the year. But if you look at a different year, let's say even the same interval, but you come down to 2011, in 2011 during that same interval, there was substantially above average rainfall. So obviously this changes over time, and that's why a good snapshot to look at is a full 10 years. So you want to try to find a 2-month interval that has, moreover than not, lower numbers in it. So the column for the interval has the lowest numbers in it, because those are intervals where you're likely to get less rain. Once you've determined which intervals you want to choose, then you move on to the coverage section. So here we're going to mark the land is used for grazing. If this was land that we were using to grow hay, we would mark it for hay. If you have a situation where you are having acreage for grazing and acreage for hay, you would just split that out into two separate quotes so that you could see the different amounts, obviously because hay and pasture land have different values associated with them. Next we come down to the coverage level, which in this case we're selecting 90%. 90% is the highest coverage level you can select, and we always recommend that people start with that highest coverage level and then work their way back if they want to. After that we come to the productivity factor, which again we want to try to select the highest limit possible, which in this case is not 100%, it's 150%. Because there might be years where if you got above average rainfall, you would have above average growth in your vegetation. So it allows you to choose 150% as your productivity factor. So we always recommend that you start with the higher and then work your way back. So in this case, for the purposes of this quote, I selected the February-March interval, and I'm going to put 50% coverage there. And I selected the October and November interval, and I'm putting 50% of my coverage there. So it's a simple 50-50 split. If you wanted to, you could go 60-40, you could go 25-25-25 in multiple intervals. There's a lot of different ways that you can move things around. The only thing you couldn't really do is select two intervals that are back-to-back, because if you look, you'll notice that the intervals have an overlapping month. So if you choose two back-to-back intervals, they're not going to let you have double coverage for that middle month where there's an overlap. So for the year 2016, if we look at the coverages that we selected, for the February-March interval, we would have had roughly an indemnity payment owed to us of $670. Which means that because we got a lack of rainfall during that time period, the policy would have kicked in and the cattle producer would have been sent a payment for $670. That payment would have been received in the month after the interval had ended, so in this case that was the February-March, so in sometime in April a check would have been sent out to that cattle producer for that indemnity payment. Then if we move down and we look at the October and November interval, we'll see that also there we received a payout. It looks as if we got an indemnity of $1,633. So that would have been paid out sometime in December. If we look at the bottom, we see totals. Now, if you look under total premium, you will see that it says $486, which would be the total cost of the coverage for one full year. However, being part of the crop insurance program, being part of the federal crop insurance structure, most of these policies have some sort of subsidy worked in. In this case, the government or the federal program would actually cover $248 or 51% of the cost of the coverage. So the farmer or the cattle producer would not be charged for that amount. The farmer or cattle producer would have actually only been billed for $239 for the year. The indemnity payment for the year is estimated to have been $2,303. So if you look at those numbers together, the farmer or producer would have been billed for $239 worth of premium that they would have to pay for the coverage, but the coverage itself would have paid out $2,303 back to the operator for the additional costs that they might have incurred due to lack of rainfall. So if we break that down for this specific plot of land, that $239 premium spread out over the 60 acres of active grazing land that the producer has comes to about $3.98 per acre to purchase coverage for a year. So that cattle producer has to ask themselves, is it worth it to me to pay $3.98 an acre to cover my land in case it doesn't rain? Going back to the index for 10 years, you take a look at the numbers again, you determine whether or not there's any changes that you want to make, You play around with the coverages. Maybe you change things from 50-50 to 60-40, whichever selection you think is going to work out the best for you. And once that coverage is done, then you can move forward with deciding that you want to get that policy. If we take a look at the 10 years of indemnity payments, if this particular cattle producer had had this coverage in place during that entire 10-year range of time, you can see in the columns where they would have received a payment for the intervals that were selected. Now, from year to year, as the rainfall data changes, the producer can choose to select different intervals if they'd like. So for this example, we just left it the same. If this person had chosen the same intervals every year for 10 years straight, what would it have been? Now, yes, there are times where the coverage does not pay out. An example here, in 2011, we got adequate rainfall, and in that year the producer would have paid for the coverage, but the coverage would not have been triggered and would not have paid out. It's just like if you're paying for automobile insurance, but maybe you've been driving around for 5 years and you've never had an accident. But if you look overall for 10 years, on average, it actually pays out more often than not to reimburse that cattle producer for losses that they would have sustained due to the lack of rainfall. So if we total that up, then over that 10-year period of time, the interval selection of February to March would have paid out roughly $6,604. The interval selection of October-November would have paid out roughly $5,213, meaning that over that 10-year span, that cattle producer would have been reimbursed from this program $11,817. Again, this is not like a scratch-off ticket where you're just getting extra money in your pocket. This is money that would have gone back to that operator to help to reimburse them for costs that they would have sustained due to lack of rainfall and therefore having to purchase out of pocket additional hay or feed to take care of their livestock. But over a 10-year span, that's an average of more than $1,000 a year that would have come back to their operations. And as a result, that money could be very useful to them in helping to mitigate their costs of their operations, to better manage their operations, and to be more effective in their endeavors to be cattle producers. That's the intention of the program, that's how it's supposed to work, and that's why it was built the way that it was built. So, I hope that this webinar has been informative. Again, just a brief overview of how the coverage works and a brief specific example of this coverage in action on some land here locally. If you have any questions about this coverage or how it works, please don't hesitate to reach out. Again, my name is John Patterson. I'm the farm agent for Stanberry Insurance. My contact information you should see on the screen there with my phone number and my email contact address there. I would be happy to have these conversations one-on-one with anybody who sees this webinar recording, which we will have posted. In addition, if there is an opportunity for me to participate in any sort of a meeting or session in which I can do a presentation like this and actually answer questions for cattle producers live and in person, I'd be happy to do that as well. Sometimes it's beneficial for me to actually put in addresses of the folks that are in the room and pull up the live and in-person examples of what this coverage would do for them and for their operations. And it really helps to walk them through that process and to show them how they can use it as a tool. The one thing I do want to mention before we get off is the cutoff date, the sales close date for this coverage through the federal program is November 15th. So if you're watching this before November 15th, now is a good time to have these conversations and to ask questions. If you have already missed November 15th, then you would have to wait for the next November 15th to sign up for the coverage. But there's still obviously the opportunity to ask questions or to learn about it if you have any questions. So just let me know, and I look forward to hearing from you again, and I hope that this was informative. Take care.